In June 2026, DeepSeek completed the largest first-round financing in AI history, over 50 billion RMB. Post-money valuation, roughly $50 billion. Tencent put in 10 billion RMB, CATL 5 billion RMB, JD 3 billion RMB, NetEase 3 billion RMB, IDG Capital 3 billion RMB, and none of them got a vote. Not a single board seat, not 1 percentage point of voting rights. Their money went into a limited partnership managed by the founder, Liang Wenfeng, not into DeepSeek itself. Every share is locked for 5 years, no exceptions. The headlines focused on the number, over 50 billion RMB, record-breaking. China's AI champion. Nobody asked the only question that matters. What did these investors actually walk away with? The structure tells you what they gave up, what the exit path looks like. And that path has a discount built into it from day one. I have spent 10 years reading capital structures in Chinese markets. From the 18A biotech wave to the star market expansion we covered last episode, same play. The gate opens, capital rushes in, and the deal structure decides who walks out with value and who is left holding a ticket. DeepSeek, same play, different scale. One number to hold in mind. Liang Wenfeng personally contributed 20 billion RMB to this round, 40% of the total. He now controls 84% of the equity and 100% of the voting rights. The founder is both the largest investor and the only decision maker. That is not normal. That is the position. Liang Wenfeng built 3 firewalls between his capital and everyone else's. Firewall 1, the limited partnership wall. All external investors, except the National AI Fund, route their capital through a limited partnership. Liang is the general partner. The LP holds economic rights, the right to future distributions, but zero governance rights, no voting, no board representation, no say in strategic direction. The money enters DeepSeek's ecosystem. The investors do not. Firewall 2, the 5-year lockup. No external investor can sell, transfer, or exit for 5 years. In a typical venture deal, secondary market sales begin within 12 to 18 months. 5 years is extraordinary. It screens out every investor who thinks in quarters rather than decades. One investor in the room told 36 CRA that Liang made a specific request. He asked everyone not to poach our people and not to encourage our people to start their own companies. The lockup is not just financial. It is behavioral. Firewall 3, the identity check. DeepSeek's team demanded to verify the background of every limited partner behind every fund. If they did not like what they found, the investor was out. Alibaba reportedly asked for a board seat. Turned away entirely. The selection runs one way. The company chooses the capital, not the other way around. Now, one exception. The National AI Industry Investment Fund contributed roughly 1 billion RMB directly into DeepSeek's equity, not through the LP. It has voting rights. It has no lockup period. This is the only external investor with governance power. The signal is unambiguous. One seat at the table. Everyone else is a financial passenger. You cannot vote. You cannot exit. So what did you actually buy? 3 things. None of them is equity. First, ecosystem access. Tencent did not put 10 billion RMB into DeepSeek for a financial return on a 5-year timeline. Tencent's AI portfolio has been playing catch-up. ByteDance has Dubao. Baidu has ERNIE. Alibaba has Qwen. Tencent's Hunyuan is competent but has no breakout moment. DeepSeek's open-source models give Tencent an immediate upgrade across WeChat, gaming, and cloud. The 10 billion RMB is a platform integration fee. And it buys something else, first-mover integration. When DeepSeek's V4, one drops with full MCP support and multimodal capabilities, Tencent's cloud and WeChat ecosystems will be the first deployment surface. First access is worth more than voting rights in a platform war. CATL's 5 billion RMB is even clearer. CATL is not a tech investor. It is the world's largest battery maker, pivoting to become an AI energy infrastructure provider. DeepSeek is building data centers. More AI training means more data centers. More data centers means more power and cooling. CATL bought a customer relationship. The industry calls this computing power electricity synergy. 5 billion RMB for a guaranteed seat at the table of the largest model trainer in the country. Is cheap infrastructure marketing. Second, strategic positioning. In the AI infrastructure race, being on the cap table of the dominant model maker is itself an asset. It signals that you are inside the ecosystem, not outside looking in. For JD, DeepSeek powers the next generation of intelligent supply chain. For NetEase, AI-generated content for gaming. These companies are not buying DeepSeek stock. They are buying a relationship that would be harder and more expensive to establish from the outside. The capital is the relationship fee. Third, option value. The 5-year lockup has a flip side. When it expires in 2031, the AI landscape will look very different. If DeepSeek has become the foundational model layer for China's AI industry, these economic rights will be worth multiples. Several analysts have described this as the Android of AI. If it has not, the lockup protected them from a premature exit at a lower price. They could not have sold anyway, but option value cuts both ways. These investors cannot rebalance. They cannot take partial profits in a secondary market. They cannot hedge. They are locked into a single position for 5 years. No liquidity, no control. That is not venture capital. That is a structured note with no secondary market. One institutional investor put it plainly. When everyone thinks getting in is itself the win, the investment has already changed from a rational decision to a collective ritual. That quote is from a 36-KR analysis published the same week as the deal. The insight is sound. Most of the debate around DeepSeek's round has been about the number. Is $50 billion too much? Too little? What revenue multiple does it imply? Wrong question. DeepSeek's API pricing is roughly 1/10 of industry standard. It has 127 million monthly active users, but revenue from API calls is negligible relative to the valuation. DeepSeek's $50 billion valuation puts it at roughly 1/5 of CATL's market cap. Yet CATL generates over 100 billion RMB in annual profit. DeepSeek's revenue is not zero, but close enough that anyone who bought at this price needs the story to work, not the numbers. The valuation debate is a distraction. The real question is not what DeepSeek is worth. The real question is, who got the good seat and who got the standing room? Liang Wenfeng occupies the gate. He controls the company, the capital, and the timeline. The National AI Fund occupies a direct seat access, no lockup, voting rights. Everyone else occupies the waiting room. They paid for a ticket. They do not control when the doors open. Position, not price. Let me make this concrete. An exit discount is the gap between what your shares say on paper and what you can actually walk away with. In DeepSeek's case, the discount was not a market outcome. It was designed into the deal from the start. 3 layers. Layer 1, liquidity discount. 5-year lockup. No secondary market. In a normal venture deal, late-stage shares start trading within 12 to 18 months. DeepSeek investors? Nothing. 5 years of silence. Academics call this the illiquidity premium. In private markets, it typically runs 20 to 40%. Translation: the $50 billion headline already has a $10 to $20 billion hole in it. That is money these investors will never see unless DeepSeek becomes the Android of AI. Layer 2, governance discount. 0 voting rights. If the founder decides to chase AGI instead of revenue, you cannot stop him, and he has already said it. Direct quote: we do not build applications, we do not do verticals, we focus only on foundational models and AGI exploration. Commercialization is a natural outcome, and it must never come before the goal. Noble vision, but when the person with 100% of the votes says profit is not the priority. Your profit, the governance discount is real, and it is enormous. Layer 3, exit path, uncertainty. Where does DeepSeek go public? A-share market, data security constraints, Hong Kong, special approval required. The US, effectively closed. Multiple investors have flagged this privately. A company with no clear IPO market and a 5-year lockup, you are not investing. You are parking capital with no guaranteed exit. There is one more layer people do not talk about. Talent. At least 5 core researchers have left DeepSeek in the past year, including key contributors to the R1 and V3 models. ByteDance, Xiaomi, Tencent poached them with 8-figure packages. Liang Wenfeng reportedly pleaded with investors in a 4-hour meeting, Do not poach our people. The round was partly about pricing employee stock options at market rate. Without a valuation anchor, DeepSeek could not compete with big tech on compensation. But pricing options and retaining talent are two different things. The money gives you the tool, it does not guarantee the outcome. If the mode is people, and people are mobile, the governance discount has a fourth dimension, human capital fragility. Add the 4 layers together. Liquidity discount, 20 to 40%. Governance discount, real, material, unquantifiable. Exit path uncertainty, compounding, human capital fragility, no lockup can fix it. The $50 billion valuation is the headline. The economic reality for external investors is something substantially less. 4 layers of discount, all priced in before the first check cleared. This is where DeepSeek's story connects to something bigger, not one company. Who controls the gate between capital and deployment? Think about what we have covered in this Disconnect series. Every episode traces the same pattern. Value accumulates at the gate, not at the end of the road. DeepSeek is the capital gate. Liang Wenfeng holds the key. The National AI Fund has a master key. Everyone else waits in the lobby. This structure is not unique to DeepSeek. It is a template. When technology becomes strategic infrastructure, control over the gate becomes the most valuable asset in the capital structure. Not the model, not the revenue, the position. Consider what happened in the same month. Anthropic released Claude for financial services. 10 named agents, 7 vertical plugins, 11 data connectors. It covers the entire workflow from investment banking to fund administration. The design principle is identical. AI drafts, human signs off. The model does the work. The permission layer controls the deployment. Anthropic is building the gate for AI in finance. Liang Wenfeng is building the gate for AI capital in China. Different domains, same principle. Position decides return. The same logic applies to the capital pathway itself. First half of 2026. 21 brokerage subsidiaries deployed 46 billion RMB into hard tech PE. CSC Financial alone put in 15 billion, a third of the market. The bottom half? Below, 100 million each, some shutting down. Same industry, same thesis, different position. Gate access to the best deals is pulling the top away from the rest. Position decides return even among the people writing the checks. And there is a deeper connection. Anthropic just raised its own mega round, H round, $65 billion, post-money valuation, $965 billion. Its annual revenue crossed $30 billion in April 2026, surpassing OpenAI. Yet even Anthropic's investors face a version of the gate problem. In June 2026, restrictions on foreign access to its most powerful models were briefly imposed, then partially reversed. When technology becomes infrastructure, the gate between capital and deployment has more than one keeper. Position decides return, and position is not just about who writes the check. For the VC or PE investor watching this, when you evaluate an AI infrastructure deal, do not start with the model, do not start with the revenue. Start with a capital structure. 3 questions. 1. Who controls the gate? 2. What discount is built into my position? 3. What has to change for me to move from the waiting room to the room? Position, not price. Even at $50 billion. DeepSeek raised over 50 billion RMB. The founder put in 20 billion RMB of his own money. He controls 100% of the votes. External investors have 0 voting rights, a 5-year lockup, and no clear exit path. The National AI Fund sits in the direct seat. The headlines say, China's AI champion arrived. I see a capital structure that baked in the exit discount before the first dollar of return was earned.
Position decide returns, not just in value chain, not just in the deployment chain, in the capital chain. Who holds the gate, who waits outside, and what it costs to move from one position to the other. That is the investment framework. DeepSeek is the case. The principle is universal. Next episode, we turn from the capital gate to the velocity gate. Why? The farthest from lab to the market is not always the winner. The velocity disconnect. See you then.